Okay, sometimes you just get things wrong. You look at the data, you look at the information that's out there, and everybody does their best to guess what's going to happen in the market. And sometimes it's just a swing and a miss.
Hey, me and a stupid monkey licking.
If you're in the mortgage business or anything where you're presenting monthly payments to people where someone is financing something, that probably sums up exactly how you feel. It is so disheartening if you're a buyer who got pre-approved and then over a 2-month period, your payment is a couple $100 a month higher than where you thought it could be. You might not even qualify at this point. So we want to look at, are higher interest rates for longer something that is just a short-term thing, like maybe through 2024? Or could we have higher rates through 2025? This article talks exactly about that. The average 30-year fixed rate mortgage jumps back to 7%. Here's why. And they go over some really interesting things, but I want to cover just in a nutshell, because as a real estate agent, home buyer, or mortgage person, we need to be able to explain to people what is going on. Why are rates going? What's going to likely happen in the future? So between April 25th and September 11th, the average 30-year fixed rate mortgage fell from its calendar high of 7.52% to a low of 6.11% after some weaker than expected jobs report triggering recession indicators, including the SOM roll. So they're talking about this right here in about April of this year to September. Look at this drop all the way from the cycle high of about 7.5% down to really rates in the low sixes, which again is important. Forget about the rates. People buy on payments. Those buyers that had been sitting on the sidelines, payments were getting cheaper. That pushes demand back into the market, right? You make things cheaper, more people buy it. Shortly after, on September 18th, the Federal Reserve, citing softer employment data, announced it would cut its short-term interest rate by 50 basis points, which they did, which is the Fed funds rate. In the following weeks, most forecasters also lowered their outlook from long-term yields, including mortgage rates. Fannie Mae forecast for the average 30-year fixed-rate mortgage rate to 6%, while Wells Fargo predicted 6.3%. Only fast forward today, and the average 30-year fixed-rate mortgage tracked by Mortgage News Daily, the same site I like to use, is back up to 7%. So again, what they're showing is just like we saw this big drop over a couple-month period, we have had this huge run-up from rates in the low sixes all the way above 7%. I can remember everyone rate is different, but man, that is a $200+ jump for most people that are in the market for a house payment that just a month ago were looking at payments a lot lower. Some of those borrowers, like I said, may not even qualify at this point. So it is a big impact on buyers and buyers' ability to buy. So this is the important part here. What's going on? After rising from a cycle low of 3.5% in April of 2023 to 4.3% in July of 2024, the U.S. unemployment rate fell back to 4.1%. In September, easing near-term recession fears and drawing away some bond buyers who have been purchasing treasuries and mortgage-backed securities as recession insurance. In a scenario where the unemployment rate begins to rise again and economic data softens quickly, we'd likely to see a greater drop in mortgage rates. But this is the important part. Conversely, if the unemployment rate remains low and inflation stays above the Fed's 2.0 target, mortgage rates could stay higher for longer. Said more simply, if the Fed thinks that there's no reason to cut rates, meaning unemployment, which just came out again at 4.1, GDP stays, increasing, which it is. We just got a good read on GDP, and at the same time, inflation stays in their target. They want to be in that 2% range. If all those things are true, the Fed is going to have a lot less incentive to cut rates. Now, I will say I do have a bone to pick a little bit with the data. I'm not an economist, and there are other people saying this, which when you look at the Bureau of Labor Statistics and the way they report not only the unemployment data, because a lot of that includes government jobs, and if a big portion of that data is from government jobs, well, governments don't lay off people. And they really, even though they're employing, people that actually make money, At the same time, they're taxing to get that money. It's not really a good measure, in my opinion, of how the economy is doing with employment. And on top of that, when you look at what the government is the biggest buyer of a lot of goods. And when you look at the amount of buying that is done by the government, that is also at a high. And that also increases, right, GDP, because the government is buying more goods. Again, taxing its citizens to get that money. But again, I'm not an economist, but there are some people saying that is scary, the amount of government, participation in these markets. But with that being said, what the market is trying to price in is what is likely to happen, and what they're starting to price in is our rates likely to be higher for longer. If all those things stay true, unemployment stays low, GDP is good, right? Inflation is not going up. Now, when I say inflation is not going up, doesn't mean things are getting cheaper. It just means it's not going up as fast as it was. But if all those things are true, then rates are going to be higher for longer. And you can see on the Fed calendar here, they just had the meeting in September, and they have a new meeting this week. But what's interesting, when you look at this September meeting and look at the markets at the same time, you can see right when they cut the Fed funds rate, this is mortgage-backed securities, rates started getting worse. As this is going lower, rates are getting higher. And actually might be better to look at the 10-year Treasury. So same thing, as Treasury yields are going higher, rates are getting worse. Right, I mean literally exactly when they cut rates, then the interest rates got higher. Which again, I showed it last week on the ChatGPT video I did, that the average spread between the Fed funds rate and the mortgage interest rate is 3.3%. And even though the Fed is likely to cut the Fed funds rate this week at this meeting, the market's still not sure about the future. And again, that's keeping rates higher for longer. You can see at this next meeting, we're currently at this 4.75 to 5% range is how they do the Fed funds rate. And almost 98.9%, we're just going to call that 100%, are predicting that rates are going to get cut by 0.25%. And then last article, and I want to summarize kind of what I would do with this information, is the 3-year change in median annual homeowner insurance premiums by county. The darker the blue, the higher insurance has gotten. And if you live in Florida, this is no surprise, you can see insurance rates across the board up 60%. And when we zoom into Florida, when we look at like Orange County, up 53.3%, Seminole County, up almost 55%. Those are huge changes, right? On top of, say, payments being a couple $100 higher, you add homeowners insurance another $100 a month higher. You can see why it is hard for buyers when rates get higher to get into the market. Now, what does all this mean? There's all this data. You don't know what's going to happen in the future. I don't know what's going to happen in the future. We were just saying rates were likely to be in the mid 5s. Now the market's saying rates could be in the high 6s all of 2025. No one knows for sure. So here's what the most important thing I think to be doing with this data. Nothing. Well, not exactly nothing. So the NAR chief economist was predicting 4.6 million homes or home sales in 2025 and up to 6 million in 2026. It's a big jump from where we're at now. If rates stay higher for longer, those numbers are not going to come true. If we have rates closer to 7%, those numbers are going to fall, and we could stay below 4 million annualized sales. So what that means is it amplifies more than ever that you better have a strategy. As rates drop and it's easier to sell homes, right? That's one thing. As rates go higher, then the real estate agents, the mortgage people that know how to have conversations with buyers and sellers about not trying to time the market, because it's going to be the same. People that time the market are always going to lose, and they don't take advantage of the opportunity that's there. It is a buyer's market now, especially in most parts of the country. And I would say in Florida, especially when you look at the trend, people aren't getting major discounts on houses, but they are getting more terms than I've ever seen. And people will tend to miss that opportunity waiting for rates to fall, demand to go up, giving them less and less options. And on top of that, if you're a real estate agent, not only just having those conversations, doing good buyers presentations and listing presentations, you better be able to have a plan in language that you know what you're doing. Of course, you know I'm talking about the daily success plan. And where I would start is with your past clients. Do you target them on Facebook with a customized audience? Are you reaching out to them through texting, calling? And if you don't really have a CRM that you can put all this together to launch all the things that you need to do to stay in touch with people consistently, even when you're busy, that's a good place to start. So if you ever want to sit down and talk about a daily success plan, creative loan programs, or things that will help you close more deals in 2024 and in 2025, reach out to me. I'd love to help. And as always, as more information becomes available that moves the market, we're going to cover it right here. Have a great day, great week, and I'll talk to you soon.